Using a stop loss. All right, protecting the downside. So first and foremost is protecting our capital, and that involves using stop losses. So remember that a stop loss, or stop for short, is just a limit order that is the same size as your trade that will automatically close your trade if price gets to your predetermined price point. At this point, you should already know what you are trading, what size range for the time frame we are trading is, and be familiar with how your stock and asset moves. So in order to have effective stops, we must focus on two things. One, not placing stops within normal price fluctuations so we don't get stopped out before our trade has a chance to develop. And two, not placing stops so far away that it kills our risk to reward ratio and therefore makes it impossible to make a profit. Anticipating the loss. So as much as we would like for a stock to come to our buy area or level and then reverse immediately to our profit targets, this is a rare occurrence, as I'm sure you probably have already experienced. We should expect it to move against us a bit at first. Actually, I like to expect that it's not going to work out and then let the market do its thing. So this lowers my subconscious expectations and allows me to just watch and read things objectively. This reduces the psychological effect of the worst thing happening to us. If we are not comfortable with an immediate loss, then again, you're either trading too big or your stop is too wide. Make adjustments. Remember that everything the market does is feedback. So if we feel ourselves getting anxious, it's because the market is not performing to our expectations. And that's a red flag, and so you need to deal with it immediately. Take some deep breaths and focus on just being in the trade, right? If you have expectations, then you are going to feel that in a very real way in the market. And I know that it seems very, very counterintuitive. You're like, well, what do you mean? Of course we have expectations. We want the trade to work out. We want to make money, right? That is our expectation. But again, going back to the mindset course, right? Having those expectations are a detriment to our ability to be in the zone and be in sync with the market, right? Because expectations can allow us to be disappointed, and being disappointed draws up negative emotions, right? So it's a self-defeating mechanism here. So again, like I mentioned up here on bullet point 2, was like, I like to expect that the trade is not going to work out. So think about it. If you come into with that mindset, you're like, okay, you put on the trade, you're like, okay, I expect it to lose. Now you've reversed the process, right? If you expect it to lose, what happens when things work out, right? Oh, well, that's just kind of like, that's a nice thing, right? Oh, it's a positive thing. Oh, cool. Well, I'm glad that it didn't get stopped out, and I'm glad that things are moving to my target, towards my target. And now we can just functionally be in the trade and initiate our plan. So what that does, it gets rid of the initial potentially negative and cloud producing emotions that can come into the equation, when really we're just supposed to be observing, right? We're supposed to be observing price action. If where we bought or sold, where we entered the trade was a legitimate level, then there should be some reaction there. And if there's not, then we totally misread things, or that's just the way the market works sometimes. But generally, most of the time, if you've read things well and you're entering in a good area, you're going to have some movement, some push in your direction. So, but it's impossible to pinpoint the exact location of where the market is going to turn, So more than likely, like I said in the prior section, was if you trade location for information, for some sort of, for price action to confirm your bias, to confirm your trade, that means the price has already made its low, has started moving in your direction, is moving further and further away from where your ideal entry would be, right? So there's just a trade-off there, and there's no way to get around that, right? So if we just mentally accept, okay, we think this is a good area of confluence, we see this is like a value area low, we see that there's the bottom of a node here, so it should have good support, that any price movement down below this level should get a bounce back up into value, or whatever, right? Whatever our thesis is, price could move you a certain amount before it makes that turn, right? So the idea is to have We want to have our stop loss outside of that level to where we give the market enough room to breathe and to do a regular movement as it moves there, and it doesn't stop us out before it runs in our direction, right? But also that we don't have the expectation that it's going to come down to our level and then reverse higher, right? So it's all about balance. And so again, like I said, if we're just clicking buttons and we're just buying and selling, everything that happens in between there is what happens in our mind. And so if we add and we attach mindset and a good positive practice with our mindset at every step of the way, we're ultimately going to contribute towards our success, which essentially is just being consistent with the way that we approach things, right? Our emotions have the biggest ability to cause us to do funny things and to do silly things that are inappropriate or do not help us, right? So if we can figure out little mental hacks, which is what this is, it's a little mental hack to get around things, right? And plus, I also like the fact that you can be pleasantly surprised. I kind of use this in life. I generally, there's certain times where you should have high expectations, but a lot of times with people are fallible, right? So as we're interacting with people in our daily lives, like, you should expect, like, people are going to let you down, right? People are wandering this earth, with a self-serving attitude, taking care of themselves. Even like our family members, even our kids, our spouse, our friends, right? They're living life, doing things. People are going to let you down, right? So if you have a high expectations that you place upon people and how they should behave in accordance to what you think is important in your view of the world, they're going to let you down. You're going to be disappointed. But if you expect that people are going to be self-serving and they're going to do things that serve them, and that they're going to screw up even when they promise things, or your best bud says they're going to do something and they don't follow through, or they forget, whatever. If you just expect that people are going to potentially mess up and have that kind of like that extra layer of grace for them, then you're able to bounce back much quicker than when you have that high expectation, it's not met, and then those same emotions creep in, right? Like anger, disappointment, like, how could they forget about us? How could they forget this was such a huge deal, and it just blew me off, or whatever, right? The same thing applies in trading, right? If we have high expectations, our chance of being disappointed increase with that level of expectation. If we have a reverse expectation, like, think about this, you're like, okay, I'm gonna go talk to I'm gonna go talk to this girl on the street, right? If you're a dude or whatever, you're like, I'm gonna go talk to this girl on the street. She's pretty. I'm gonna go chat it up with her real quick and see if I can get her phone number, right? If you expect her to say no, and if you expect her to blow you off and like not even give you the time of day, your expectations have shifted into the point where it doesn't matter. Like, you're expecting them to say no, right? So when they say yes, then it's just like, it's a nice little bonus. It's like, oh, well, that's cool. All right, well, cool. And it just takes the pressure off as well, right? It takes the pressure off of the trade when you don't have the expectations, or you have the expectation to lose, that you're going to lose. So anyways, I probably went way too deep of a rant for that, but I tried to bring it home as best as I could. So, all right, capping losses for the day. So I generally have a 3-strike rule on the day, and this is generally for day trading. But this means that if I tried to strategically enter full size at 3 separate times and they're all losses, then I will be done for the day. I may stick around and watch price action, but I will risk no more funds. So this prevents me from ever damaging my account on any one given bad day, which can hurt you psychologically and financially. We want to approach each day as brand new, not carrying baggage from the previous day or trade into our next one. So protecting our capital to live and fight another day is much more important than letting our ego take hold when we are obviously not seeing the market clearly. For me, these days generally happen when I haven't anticipated a range type day or scenario. So, and all that means is that, if I'm in trend trading mode and I'm trying to strategically place my trades in a way that is set up for market continuation, and we keep bumping against that, outer level of the value support or and resistance areas that just bump us back into that rotational, and I'm just stubborn. I'm like, nope, I think we're gonna go higher. Oh, all right, things are looking positive, things are moving up, so I think that we're gonna break out, and not identifying that, hey, more than likely we're in a rotational type scenario, and so you need to be a bit more aggressive with your profit taking and be more strategic and wait for those deeper pullbacks before you get in. That can completely shift the profitability of the day, and you don't let your mind take that information in, right? Then that's how you end up with a negative day. So if there's days, so that's what this is that if there's just days where you're just not getting it, you're just not in sync, this loss rule kind of keeps you safe from that. Eventually you're just like, okay, you just stop trading, you just watch. All right, slippage. So what is it? If you're not familiar with the concept, slippage is what happens when volatility increases, price begins to move in a direction faster, and orders executed by buyers and sellers at each price point becomes less dense, right? So they call this like the order book becomes thin at that point. This means that your market or even limit orders can get executed at worse prices than you anticipated, sometimes in your favor, but usually in the opposite, right? So at this point, like, you know, you can place a limit order, and most of the time you're not going to get filled anyways when price is moving, right? Unless you're letting price come back into it, like you're entering on a pullback. But when a news report is something that's come out and that order's trucking and you just put a limit order in there, A, it's probably not going to get hit. B, if it does, it can still get filled at a different price than what you asked for, right? And that's much different than even just a random buy or market sell order, right? Those can get skewed really, really far depending on the volatility. So this is something you need to be careful with, right? And this is essentially a liquidity issue, right? The more liquidity, the more buyers and sellers doing business, and the tighter the bid-ask spread, as there are plenty of buyers and sellers, while a less liquid market is exactly the opposite, right? So to break this down further, as you've seen in market and particularly volume profile, there are areas where the volume is thick and areas where it is thin. And if you have a large amount of stops in a thin area just below a heavily traded consolidation, then if the market trades lower, all of those stops essentially become limit sell orders, along with everyone rushing to exit the trade as price moves lower and lower. And that's not including the people selling, looking to take advantage of the move, right? So you can see how things snowball, and also the importance of like the market profile and noticing those underlying areas where, you know, if you're just looking at a regular chart and you're seeing chart bars, you don't see the actual support and the volume and the amount, the density of what's happening underneath that. But with market profile, you're able to see that, right? So when we talk about things accelerating, right, this last kind of paragraph that I just read, that becomes a very real thing. And that's the reason why breakouts can be a legitimate strategy, right? Because that move can go exponential based on those things. And just like it can go exponential, just like that, as it moves into low volume areas, that volume can dry up as well, and it gets sucked back into value, right? So orders can become lopsided, and you are at the mercy of the market as to where your desired price gets filled. Therefore, you must be prepared and expect it to happen sometimes. Expect it and factor it into your trading costs. Consider it a cost of doing business. And we know if our costs of doing business go up, then we need to maximize the money that we keep.